What's up, guys? Stacy here from Becoming Financially Fit, and today I have an interesting topic lined up for you guys. We're going to be talking about tax loss harvesting and what that really means, and how I actually did a little bit of tax loss harvesting before the year end to lower my tax burden when it comes to capital gains. Before we get into the content, I make videos about personal finance, financial literacy, savings, investing, and I also try to throw some entrepreneurship in there as well. So if you're interested in any of those topics, make sure you subscribe to the channel and don't forget to hit the bell to be updated anytime I post new content. All right, let's get into it. So in terms of tax loss harvesting, what really is it? So essentially, it's the process of selling out of position that has an unrealized loss, creating a realized loss. So that means you take a loss on that position with the idea that you're either going to replace it with a different stock and keep the investing process going, or you're going to wait 30 days and repurchase that stock. So you can realize some of that loss and lower your taxable burden in terms of short-term or long-term capital gains for that year. Or what you can do is you can kind of look at your stock portfolio, realign it a little bit. If you do have some losers in there, cut those losers, lower your tax burden, and then reinvest that money into some stock that you think are going to be good for the future. So who is the tax loss strategy really geared towards? It's geared towards individuals who have a stock portfolio. They maybe have a collection of different stocks or different ETFs, index funds, things like that, where throughout the year you've made some sales and you incurred some either short-term or long-term capital gains. But then you still have some of those positions in your portfolio that may be down 10, 15%, just because you purchase them at the wrong time. And with stock investing, that happens. You can't pick 100% stocks that are going to go up, but we do have ways to actually help you guys realize some of those losses. And this is what tax loss harvesting really does. So just to give you guys an example, let's say I purchased two stocks on January 1st. I purchased AT&T and I purchased Apple. So throughout the year, Apple's been doing great. It's went up a bunch, right? So I have a huge unrealized capital gain. Let's say it goes from $100 to $400. And I sell out of half of that position, which leaves me $200 in Apple and $200 in cash. But because I sold that position, now I have a $200 capital gain. And because I bought it this year, it's going to be a short-term capital gain, which means it's going to be taxed at my normal rate. And let's say that AT&T stock, same example. Let's say I purchased it at $100, but now it's gone down to $50. So what I can do when I'm looking at my stock portfolio and I'm thinking about tax loss harvesting is I can say, hey, you know what? I'm going to sell out of my AT&T position, realize a $50 loss on that position, and I'm going to go and I'm going to purchase, let's say, a portion of Amazon. So now what happens is I still am investing the money in my portfolio. I just used the money that was in AT&T and I sold it, put it in a new stock. And now instead of realizing a $200 capital gain, because I took a loss on that AT&T position, I now have a $150 capital gain, which lowers the amount of money that I need to pay taxes on when it comes to capital gains. So you can see how this works throughout the year. If let's say you get to sometime like December that we're in right now, and you look at your portfolio, you've made some sales throughout the year, some are up, some are down, and you're looking at some positions and you're thinking, I really do think this company is still going to be a good company, but they, have been hit pretty bad. This may be because of COVID or the pandemic or different things that arise that, makes the stock of a company go down, and I want to sell out of it. What you can do is you can have, two options. You can either sell out of that position and reinvest those funds into a different stock, realizing the loss and lowering that taxable burden. Or what you could do is you can sell out of that stock. But if you really do think the stock is going to go up over time, you can wait 30 days. And after that 30th day, you can go ahead and repurchase that stock. So now, what are some of the pros of tax loss harvesting? I kind of want to give you guys both sides because I don't want to just give you guys the rosy picture about how you can lower your taxable burden each year, because there are some pros and cons. But just starting on the pros, it's a good way to reduce your tax liability. Like I said, no one wants to pay taxes on short-term capital gains because it's taxed at your normal tax rate. Everybody wants to have long-term capital gains because it's taxed more favorably. But at the same time, sometimes you do buy and sell stock stocks, if you're a trader, if you're an investor, it does happen. You get into a stock, you might have a great, run on that stock, you sell it, but now you have capital gains that you need to pay taxes on at the end of the year. It's a great way to reduce those taxes. Another way that tax loss harvesting can help you guys out is if you're using the strategy where you're looking at your losers, you're selling them, but then you're using those funds to get reinvested into different stocks. That actually is a great way to stay invested into the market. And I think, as we all know, that the market can go up and down any normal day throughout the year, especially in a year like 2020. So it's always good to stay invested over the long haul. And that's what I do. I'm a long-term investor, but I like to go in every now and again, pick some stocks that I like, see some stocks that haven't really done well throughout the year, and then trim those a little bit, rebalance my portfolio while, thinking about if I'm going to be paying taxes at the end of the year. One of the cons that I do want to point out that I don't want you guys to get lost in this whole discussion about tax loss harvesting is the fact that if you do want to sell out of, let's say, a position, but then wait 30 days and get back into that position, there's going to be a 30-day period where you're not invested in that particular position. So for example, let's say November 30th, you want to get your tax loss harvesting in before the year end, you sell out of position, but then there's some great news about the company and they go up 10%. You're not going to be able to have those gains because you sold the position and you need to wait 30 days in order to actually realize those losses. That's a rule. It's called the wash sale rule that I would highly recommend you guys go check out, which pretty much states that if you sell a position for a loss, you can't repurchase that stock or a similar stock to it for another 30 days, or that loss that you realize will be wiped away. So important thing to note, sometimes it's good, sometimes it's bad. Like I said, there are ways to actually go around that 30-day rule, and that would be purchasing a stock that is not similar and not the same stock that you purchase during that 30-day period if you really want to stay invested in the market. Another thing I want to note about tax loss harvesting, which might be a downside, is the fact that your holding period is going to reset. Let's say you've held a stock for 11 months, but you're thinking about tax loss harvesting. As soon as you sell that stock and try to repurchase it 30 days later, because you sold it, now your holding period starts again. So if you're on the cusp of hitting that, 1 year period, which turns your stock from a short-term hold to a long-term hold at the 12-month period, then that's something to think about as well. Because like I said, the most favorable capital gains in investing are going to be long-term capital gains, but you can't really do that if you don't hold the stock for, like I said, 12 months at a time. So when you're thinking about doing some tax loss harvesting, if you're going to be selling out of a stock, but you're right about to hit that 12-month period, it might be better to look at a different stock that's maybe down, or maybe think about just holding that position because you don't want to lose those favorable long-term capital gain tax treatments. So guys, in summary, I just wanted to give you guys some great points about tax loss harvesting, its pros, its cons, and the way I use it. Like I said, throughout the year, I use it to not only go in and look at my portfolio, but also to rebalance, to cut some of my losses, to reduce my tax liability, and then to go in and look at my overall picture and see where I stand in terms of investing throughout the year. If you guys like the content I'm putting out, make sure you guys subscribe to the channel and don't forget to hit the bell to be updated anytime I post new content. And question for you guys to stay to the end of the video. I want to know if you guys have ever heard of the term tax loss harvesting, and if you guys have some stocks in your portfolio that this might be a good option for. If you have one, drop a comment below and I'll talk to you guys in the next one. See ya.